Good morning from London. I'm Kriti Gupta alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Asian leaders meeting in the APEC summit in South Korea, where Nvidia CEO Jensen Huang is expected to speak. When he does, we will bring you those headlines live. And of course, off the back of the U.S.-China trade negotiations, China buys more U.S. soybeans, but exporters starting to get wary of bumps that may come down the road. And of course, we are in earnings central. Amazon posting blockbuster earnings with its cloud unit growing by the most in almost 3 years. Apple right on its heels, the anticipation of holiday sales boosting that stock, Tom.
And those tech numbers are certainly part of the factor when it comes to these markets. And US futures pointing to a strong session, making up for the losses yesterday. You saw a pretty significant sell-off, particularly when it comes to the Nasdaq 100, on concerns about Meta and Microsoft. That huge debt issuance as well, $30 billion from Meta. Mark Zuckerberg then tapping the markets to fund that CapEx story. But that was not welcomed by investors today. A different story to Kriti's point in terms of the optimism coming through for the likes of Amazon and Apple as well. European futures, though, currently pointing low by 0.2%. The optimism is now reflected in the futures for the US. Nasdaq 100 futures pointing to a decent session, up more than 1%. S&P even is looking to add 40 points. Euro dollar on the back of that ECB decision, of course, fully expected to hold rates 115 right now as we count down to inflation later this morning as well. Largely unchanged on the single currency. We will watch that on the inflation print out of the Eurozone. The countdown to the opening trade starts right now.
Happy Friday to our global audience. Happy Halloween, apparently. That's a very exciting day ahead. But before we get to the celebrations, we should talk about some of the serious news. It's been a blockbuster week for central banks, for geopolitics, and, of course, for the earnings picture. Let's tie it all together, Tom, because the conversations continue. Donald Trump has left Asia, but Asian leaders, they're still meeting. They're still engaging with China. They're still working out deals that don't necessarily include the United States. Yeah,
the deal-making is there at a corporate level. The deal-making is there between nations as well. Really interesting to see that in the last hour or so, you did have a meeting between President Xi Jinping and Mark Carney of Canada. Of course, Canada and the US struggling with their own trade issues. President Xi on the back of that meeting, of course, and that conversation, more than 90 minutes with President Trump. He's also spoken, President Xi, about the need to ensure supply chains globally, a message that may be met with a mixed response given the rare earth export controls that China is looking to put into place. Those have been delayed now by a year, benefiting, of course, the US and China's other trading partners. But as you said, these are deals, or at least conversations on the sidelines of the APEC summit that are happening between national leaders, but also some deal-making when it comes to Jensen Huang. We may hear from him. We're expecting to hear from the leader, of course, of Nvidia, and the deal-making just coming thick and fast, partnerships now with South Korean partners like Hyundai and Samsung. Yeah, it's a fascinating one because, of course, Nvidia has been on kind of a deal-making surge. We had Deutsche Telekom and Nokia earlier this week. We had plenty of commitments over in the States going into last week, and, of course, that remains a key theme. The rare earths piece is really fascinating. We're going to have a guest later that's going to talk about this and whether or not we can actually see this start to continue. Scott Bessent, of course, making some comments, I believe, on Fox News last night, saying that in a year's time, when these trade negotiations come back, we're likely to delay it again. So some of the sentiment that we got that maybe this is a exercise of kicking the can down the road seems to be something that is being validated by the White House. Of course, the tech story is multifold. We have the Nvidia conversation. We have plenty of earnings from this week as well. I think it's a real reminder this week that these are idiosyncratic stories now when it comes to some of these big mega cap tech stories. They all have different approaches. They all have different value propositions. Google, for example, and Alphabet with the full stack, everything from the chips through to the data centers, through to the product and the models. And then, of course, yesterday, Meta with this remarkable story around tapping the debt markets. And you expect that to continue, not just for Meta, but others as they look to build out the capex. And investors reacting very differently to each of these stories. Meta, of course, punished on the back of that in the CapEx spend. Amazon, though, and the AWS strength, and given that AWS is the leader when it comes to cloud, growth of around 20%, $33 billion in revenue, the strongest growth rate in almost 3 years for AWS of Amazon. That is the key profit driver at this point. And I think really interesting as well, the CEO of Amazon, Jassy, of course, detailing for the first time how AI being implemented is, in fact, powering some of their business units. And this answers part of the question around where is the return on investment. And Jassy gave some details there. The shopping chatbot at AWS, or at least at Amazon, it could add $10 billion in annual sales. They have a call center product that's on track to pull in $1 billion in revenues. That, for me, was interesting. Details around the ROI on the spend. And again, they see the data build out data center build out for Amazon and powering into next year.
Well, it's fascinating as well because Amazon, I think officially off these earnings, you can say this is now officially a software company. I didn't see anywhere the analyst report that a ton of, or analyst reports off the back of the earnings really giving that much attention to their e-commerce business at the end of the day, which is, by the way, the dynamics that are driving Apple stock higher. They're talking about coming to some better numbers in China, which of course they've been trying to permeate for a very long time. But the real heavy hitter was the fact that their iPhone sales, they're expecting a blockbuster holiday season. I think that one was a really fascinating conversation for Apple, which is a company that, of course, yes, is very hardware exposed, but 30% of their revenue is still services. It's still the people who are coming in, getting their, fixes at the Genius Bar, for example, and getting their Apple Care or whatever. That's 30% of their revenue. And it feels like Apple was very upbeat at a time and at a quarter when I think a lot of people were saying, is this where the tariff read-through shows up? Is this where the supply chain issues show up? Apple's saying, no way.
The tariffs costing Apple $1.1 billion US, but to your point, they're absorbing that. It's pretty impressive, again, just to lean into what you're saying, that Apple are projecting a very positive current quarter in light of the trade tensions, in light of the supply chain challenges, in light of that tariff hit, $1.1 billion US, which, of course, in the margin for Apple is a drop in the ocean. But at the time when they are not winning on AI, so despite all of that, they're projecting stronger sales. Yes, China is a challenge for now. In the quarter that they reported on, they saw a drop bigger than the forecast expected. The competition is fierce, but they do expect a turnaround on the Chinese story. If they get that and if they get AI, then the picture looks a lot brighter for Apple.
Yeah, well, we'll stick with the China story as well because we're using it from a lens of the U.S. corporates going into China. Let's talk about the Chinese economic data as well because, look, they're juggling trade deals, they're juggling geopolitics. There was some conversation about whether or not they would include energy purchases from the United States off the trade deal that has yet to be confirmed by the Chinese. But I think what's really fascinating here is that they are still dealing with a slowing economy. They are still dealing with factory data that we got out this morning that didn't look as strong as perhaps expected. There is still a massive fiscal stimulus story that shows up in China and permeates through that story. Tom, I feel like this is like the Tom Mackenzie day, the tech in China theme radiating throughout the world.
Well, they're going to get some relief, of course, from that 10% cut to tariffs on the fentanyl tariffs, 20% to 10%. So there will be some relief there. Longer term, Bloomberg and the team over in Beijing reporting that exporters in China, manufacturers in China are preparing for more volatility longer term and continue to build out their own supply chains in countries like Vietnam. But to your point around the factory orders, that was the data that came out today. The longest streak in terms of slowdown in factory orders for 9 years in China now. And analysts predicting that in the last 3 months, the slowing performance, you're expected to see the slowest performance when it comes to factory output in China since the COVID-19 lockdowns, the COVID-0 lockdowns. So the challenge is there. It's the new export orders that were really soft in this data. It's the domestic economy. Yes, manufacturers in China have found new markets beyond the US, but in terms of the domestic story, with the real estate slump that continues, the consumer still not having that confidence, and fewer purchases in the domestic economy, that remains a challenge for this Chinese economy.
At the end of the day, China is still an export-driven economy, the way that the U.S. is a consumer-driven economy, even though the leaders of both sides would perhaps like to change it. That being said, it's going to be a key feature in some of our conversations ahead.
Let's bring you up to speed then on what else to expect through the show today. A really big interview coming up in the next few minutes. Kristalina, Georgieva, the IMF Managing Director, joining us from that APEC CEO Summit then. We will bring that interview to you shortly, and later in the show, Luigi Speranza, the global head and chief economist at BNP Paribas Markets 360, joins us on set to discuss all things central banks, the spend around the AI capex story, and maybe look ahead as well to the inflation data out of France. And Anne Milletti, equity investments head at Allspring, joins us for the market open on how to position around these markets that, of course, still remain near record highs. And then Dominic Rubb, global affairs head at Appian Capital Advisory, former UK deputy PM, of course, on the need to focus and get capital into the rare earth space. Very timely conversation, Kriti.
Absolutely. Plenty of data as well to keep an eye on because, of course, the conversation is not over, even though I feel like that Friday energy is starting to pick up. Of course, APEC leaders are meeting in South Korea for that summit. You are seeing CEOs attend that as well. Plus, plenty of data. 10 a.m. UK time. The French, Italy, Euro area, October CPI numbers are all going to be hitting out. Do we start to see that maybe back some of the case that Christine Lagarde made yesterday? And And then plenty of Fed speak from across the Atlantic starting at 1:30 p.m. UK time. We've got Logan, Hammock, Bostic all speaking over in Dallas, Texas. And then, of course, earnings continue over in the States as well, this time for big oil, Exxon, Chevron. Some of that exposure that you were going to start to see went to the Middle East, but also to the conversation in South America and Latin America, specifically Venezuela, where Exxon and Chevron did used to have big holdings. Chevron still has one. So that's going to be a key piece, of course, as that is a conversation that permeates throughout the United States right now. We should talk about the fact, speaking of CEOs in South Korea, that Jensen Huang has officially taken the stage.
He has taken the stage. We're watching for lines, of course. We know they're doing a partnership. There you can see him, the CEO of Nvidia. And, of course, he mentions companies and the stocks move on the back of this. We know he's done deals already in South Korea with Hyundai and with Samsung. A big push, again, around sovereign AI. And he is winning on that front when it comes to South Korea. There are commitments at the national level and at Samsung as well to build out data centers filled with GPUs on the Blackwell design. Hyundai, the car maker, as well, thinking about automation, and they are partnering with Jensen Huang and with Nvidia. We're waiting for additional lines coming through, but this is significant. Very interesting as well, a photo that has made the rounds in South Korea with Jensen Huang sitting alongside Samsung CEO and Hyundai CEO in a chicken shop, and chicken stocks have jumped on the back of that. Let's listen into Jensen Huang.
Computing approach requires tremendous amounts of algorithm software to be developed. We call it CUDA-X libraries. Very few people talk about this, but this is NVIDIA's treasure. These libraries make it possible for us to apply accelerated computing to computational lithography, the work that we do with Samsung, or in deep learning and robotics, the work that we do with many companies here that I'll talk about. It allows us to do quantum physics. It allows us to do quantum computing, molecular dynamics, fluid dynamics, robotics, of course, artificial intelligence. These libraries open new markets.
Okay, Jensen Huang, the CEO of Nvidia, of course, speaking at the APEC CEO Summit. We'll keep across that story for you. Any new details that Jensen Huang mentions in terms of his partnerships and deals? We know he has been on a deal-making flurry, of course. Here's what else you need to know this morning. Bloomberg has learned that Germany is considering using public funds to pay Deutsche Telekom and other operators to replace Huawei equipment. Sources say the cost could exceed $2.3 billion. Netflix has approved a 10-for-1 stock split to make shares more accessible for employees on its options program. It's the second split in the last 10 years for the streaming industry leader, which has routinely beaten market expectations for earnings. Stockholders at the close of trading on November the 10th will receive 9 additional shares for every share held, with the split expected to take effect a week later. Novo Nordisk has made an unsolicited bid for US biotech firm Metsera, sparking a heated battle with Pfizer to get their hands on weight loss treatments that both drug makers want in order to regain lost ground in the booming market. Now, Pfizer has 4 business days to come up with a better offer. Metsera's board of directors says it could walk away from the Pfizer deal should Novo's offer appear superior.
Lots to cover in the show. Coming up, more on the top lines coming from Nvidia boss Jensen Huang, who, of course, is set to announce more AI deals. He's on stage at the moment. We will bring you the latest. Plus, as Tom just mentioned, we will get a check on Pfizer. Novo Nordisk, the Danish drug maker, upending the U.S. firm's bid to acquire the obesity drug company. Excited to see how this is going to show up at the Open. Up next, though, we head back to South Korea and the APEC Summit for a conversation with Kristalina Georgieva, managing director over at the IMF. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Welcome back. Happy Friday. We are fewer than 45 minutes away from the opening trade. Let's return to one of our top stories now, the APEC Leaders Summit, where Chinese President Xi Jinping has warned against breaking supply chains in his first public remarks after the pivotal meeting with his US counterpart, Donald Trump. Bloomberg's Sherry Ann is on the ground for us in Busan in South Korea with a very special guest, Sherry.
Yeah, you said it, Tom. I mean, the environment here at the APEC Leader Summit, much more positive with that one-year trade truce between the U.S. and China. Let's discuss what it all means for the global economy. And I'm joined by the IMF Managing Director, Kristalina Georgieva. Thank you so much for making the time here in Gyeongju, South Korea. It's great to see you.
My pleasure.
So you're coming off a meeting with the South Korean President Lee Jae-myung. What did you guys talk about? I mean, the mood must be much, much more positive now.
Well, he has provided a remarkable leadership to APEC in a very difficult time. Both in the room, the conversation was very constructive, and of course the side discussions and agreements reached are very significant for the world economy. Let's recognize President Lee Jae-myung for the leadership in Korea as well. What we have seen here is very rapid recovery from the turmoil that was caused by political processes in the country. We see growth in Korea next year going up to almost 2%. The fiscal position of the country is strong. It is used very wisely to inject more dynamism in the economy. Korea is on track to spend around 4% of GDP for the ultra innovation economy, and that of course is going to lift up growth prospects even further.
I mean, not surprising, this whole APEC, the focus has been on artificial intelligence, and yet concerns are there about a potential AI bubble, and the IMF has warned about potential stretch valuations. Could that still be a risk?
Well, we're talking about two risks. So one is valuations have gone up. For fairness, it is because high-tech companies are also highly profitable, and this is why money flows there. But if the impact on the rest of the economy, in other words, penetration of AI is slower to materialize, we may see pull back, and that creates a financial stability risk. And the second risk we are warning about is, are you going to really transform the economy across? In Korea, the beauty of this ultra-innovation economy is that AI is to play its role everywhere, in agriculture, in shipbuilding, in beauty products, everywhere AI is placed to increase productivity. Now, when we think about the future, we see one particular aspect that is not getting enough attention, and it is what is going to happen with labor markets. So Korea is wise. We expect to see across the board penetration of AI, but in some countries the attention is not on that. It is on let's go up, 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 wherever we can do it faster. We assess AI to affect 40% of jobs globally, 60% in advanced economies. Some would become more productive, some would disappear. This is like a tsunami hitting the labor market. And are we ready?
Right. I mean, the digital divide could just get more and more bad at this point. But also at the same time, we continue to see the tech rivalry between China and the U.S. in this sector, right? How much comfort does it give you that we achieved a one-year trade truce, and does it change the economic outlook for you?
Certainly that is going to have a positive impact on the world economy because it reduces uncertainty and because it creates conditions for the two largest economies to perform better, good for them, good for their neighbors, good for the whole world. So thank you, Korea, for hosting a meeting that brings this good news.
When it comes to the tariffs, so how much of that impact has already been felt by the global economy?
Well, the world economy has proven to be remarkably resilient. Growth from last year, 3.3%, has slowed down to only 3.2% this year, 3.1% next year. So that is not as dramatic as we feared. But let's be fair, 3% or around 3% is just simply not good enough. We used to grow on average 3.7% before the pandemic. Why is growth slowing down? Yes, trade uncertainty is holding it back, but more significantly, lower productivity is holding it back. And this is why the bet on AI to lift up productivity.
What are the metrics that you're watching in order to see that you actually get, say, sustainable productivity that will help you grow out of all of these investments and also the debt that's surging, not only in the public side, but even the private sector?
So what we are looking at are three things. One, you're right, we are looking at levels of debt. In the public side, soon to reach 100% of GDP, what does it do? It holds the ability of governments to make strategic investments back, and it is expensive to serve. Interest rates in many places are still quite, felt by the purse that is paying it. But the other thing that we are watching is what is happening in terms of the preparedness of countries for the most likely driver of productivity, AI. And there we are ranking countries, we have an AI preparedness index on four things. Infrastructure. Can you actually connect the economy to tech? 2, labor markets. Are they ready? 3, is innovation penetrating the economy? And 4, and the fourth is the trickiest, regulation and ethics. What is going to be the social compact of a world of artificial intelligence?
Given the macroeconomic backdrop and also the productivity variable coming from artificial intelligence, does it make sense for central banks like the Fed to be a little bit more cautious in acting?
The Fed, at the time of uncertainty, has to carefully put one foot in front of the other. And in that sense, a decision was taken to cut 25 basic points now, and at the same time, a cautious announcement around what may be coming next. Why? Because tariffs are pushing some prices up, not a lot. The impact is mute, partially because of prepositioning of goods, partially because companies have healthy profits, so they can eat up some of these tariffs, but it is popping up. And on the other side, the labor market seems to be weakening. So how do you balance that? The Fed would be wise to do it carefully.
We have 30 seconds, but how well are Asian economies doing, especially given where the Fed is going?
Well, the Asian economies are also very resilient. They're performing well. Inflation in most of Asia is very low. In some countries, maybe a bit too low. And Asia is thinking about cooperating more within Asia. We see it in ASEAN. We see it here at the APEC among the Asian leaders.
IMF Managing Director Kristalina Georgieva, always great to see you. And today here in Gyeongju, South Korea. Back to you guys in the studio.
Bloomberg Sherry on in South Korea, of course, with the IMF Managing Director. We thank you so much. The subscribers can also turn to the terminal for more on this. TLIV Go is your function for the latest when it comes to that summit. I think what's fascinating in that interview, Tom, is that she talked about, and you and I both kind of looked at each other, she said it, that AI was a tsunami that is hitting the jobs market. So she's already in the camp that this is really revolutionary.
Yeah, and she was clear. Look, 40% of jobs globally will be impacted. She didn't say all of those would be lost. Some would be lost. Some would be transformed. And so that is the take from the IMF. Also saying that the global economy has been relatively resilient, above 3%, but she wants to get it back up to that 3.7% or above pre-pandemic. So she says there does need to be greater alignment on that case. But relative resilience, she was asked, of course, about the debt concerns at a national level and then at corporate level, and says that is something they're watching. But this is clearly someone as well relieved by the détente that has taken place between China and the US in the last 48 hours. And she articulated that, at least for the next 12 months, saying this is good news, not just for those two economies, but for the global economy as well.
Yeah, the détente is fascinating. Does it last beyond those 12 months? And is that something that is welcome news to those markets? Certainly, we saw that price action earlier this week. Coming up on the program, we're going to check in on that theme. Is this a permanent trend? Is this a positive for the global economy? And how does this all square with how the central banks are thinking? Luigi Speranza, chief global economist over at BNP Paribas, joins us around the table next. Stick with us. This is Bloomberg.
We are 30 minutes from the start of the opening trade this Friday. European futures diverging from their US counterparts, currently pointing low by 0.1%. US futures, S&P E-minis pointing to gains, though, up 0.6% after a challenged session yesterday on concerns emanating from the spend around CapEx from the likes of Meta and Microsoft. But Amazon and Apple riding to the rescue with strong results and a forecast of strength as well. AWS at Amazon performing very well as well. We'll get the details for that. Nasdaq 100 futures then on the back of that pointing higher by a little over 1%. So making up from some of the losses yesterday. It was a tough day again for the Nasdaq 100 yesterday, but the futures picture looking slightly brighter. Jensen Huang has been speaking at the CEO Summit, APEC, of course. He's wrapped up those comments. He's talked about some of the deal making. We know he's aligned with the likes of Samsung, a big build out plan in South Korea, but also Hyundai as well. So the deal making continuing from Jensen Huang, also saying that he wants to start that conversation around Blackwell chips into China, but hasn't got there yet. And we know that didn't, at least according to President Trump, didn't come up in that meeting between the two leaders yesterday.
Yeah, it's fascinating. But he did make the comment that even though that they're expecting a 0% exposure to China, anything else would be a, quote, huge bonus. And that's going to be an interesting piece that we continue to watch. Is the market pricing in that huge bonus? We'll put Nvidia to the side for a second. We've got plenty of other tech earnings to work our way through. Matt Bloxham of Bloomberg Intelligence has been all over it. He joins us now around the table. Matt, we were here 24 hours ago, and we were kind of like, oh, we don't know how we're going to feel about Apple and Amazon. They came out with some blockbuster numbers. What stood out to you?
They really, so obviously on Amazon, it was the cloud number, 20% growth in that business, and a very optimistic set of commentary from the CEO, Andy Jassy, about the forward pipeline of demand. So I think kind of, really finding that sweet spot investors are looking for about matching the certainty of the revenue, on a kind of 1 to 2 year basis, and the investment they're putting into that platform. And obviously we saw really good numbers from Google and Microsoft and their equivalent cloud businesses. Obviously, Amazon is the market leader, I think. So some question marks about whether they were taking share, but it seems like there's enough demand out there to kind of keep them all happy.
When it comes to Apple, are investors right to look through the challenge in China for that company?
I think so, and certainly that the CEO, again, made some kind of positive commentary about China for the festive period, expecting to return to growth. And that certainly kind of matches some of the channel checks we've been hearing about. And I think, it's slightly kind of put in the shadow by just the overall optimism and momentum that the iPhone 17 has. So even if China is still a bit of a kind of mixed market for them, there's enough demand from the rest of the world for the new 17. They're talking about 10 to 12% growth in iPhone revenue in the festive period or festive quarter. That would be a doubling of the trend we saw in the quarter they've just reported. So really good momentum. And again, it kind of confirms all those channel checks that the 17 has landed well with consumers.
Let's just take a massive step back here, zoom out if we can.
Yeah.
We went into this tech earnings season talking about real worries about CapEx spend. Do those worries still exist if a lot of these firms have now, one, proven that they can still stick with some very high liquidity cushions, but also the fact that they are actually able to turn a profit on some of the investments that they've been making?
I think those concerns are still there, and I think we saw that quite clearly yesterday with the share price reaction for Meta. And I think there's a growing distinction between the speculative investment, which I think is where people are perceiving that the Meta investment, that there isn't a very clear revenue opportunity attached to the money they're spending, compared to a Microsoft or compared to an Amazon, where there is very real near-term demand for what they're selling, and it's a much more visible return on investment they're getting.
Matt Bloxham, thank you very much indeed, breaking down what has been a significant week when it comes to tech earnings, of course. Different stories for these different companies and how they're all positioning around the CapEx spend and that demand. Matt Bloxham, of course, from Bloomberg Intelligence. Let's get a wider picture now on the macro impact of the tech spend, but also the central bank action as well, because, of course, we've had the ECB front and centre, but also the Fed with that cut, but warnings around December. Let's bring in Luigi Speranza, Global Head and Chief Economist at BNP Paribas Market 360. Luigi, great to see you this morning. Thanks for joining us bright and early around the set. Let's start with the CapEx spend then, and to what extent you're factoring that into your forecast for global growth into 2026. How much of a catalyst is it? To what extent is the CapEx spend around AI underpinning this global economy at this point?
Good morning. And CapEx spending, certainly a key factor underlying the resilience of the global economy, and our view, which is quite benign for the macro outlook in general. But let me say the direct impact of investment probably underestimates the overall effect, because on top of that, there is a sentiment effect on corporates, because they are looking already at potential productivity gains from this investment. And at the same time, there is a wealth effect, because we see this in the evaluation of the equity market, which has an impact on consumption. So I think the overall effect is actually bigger than the direct impact from investment. And the other point is it's not just AI. I think the fundamental factors are supportive. Fiscal stimulus, easier monetary conditions, and how to say, a less degree of uncertainty following the trade truce between US and China. So I think all these factors underpin a benign outlook for the US economy, but also the global economy more in general.
A benign outlook for the global economy. We were just hearing from the IMF Director General saying she wants to see this global economy getting back to pre-pandemic levels. Do we get there in 2026, 3.7% and above for global growth?
I think prospects are for an improvement here of the growth outlook. Again, the fundamental factors are supportive. And I think easier monetary conditions have still to work through the economy. They always impact the economy with a lag. And so we have not seen yet the full impact from the monetary easing we have seen so far.
Well, speaking of that monetary easing, and I want to get to the ECB in a moment, let's focus on the Federal Reserve, given that that's where this is going. Kristalina Georgieva had also said that the AI boom is likely to, in her words, act like a tsunami that's going to be hitting the labor market. Do you feel like this is a Federal Reserve that is responding to the labor market or still responding to potential inflation risk?
Well, that's really a debate at this stage. I would say that the risks are on both sides of the mandate, which explains the divisions within the committee. On the one hand, you have the labor market deteriorating. Labor demand is slowing more than labor supply. So this creates a risk of, if you want, negative feedback loops. On the other hand, inflation is still elevated. So there are divisions here, and I think there is a different approach amongst different members to risk tolerance towards inflation. But I remain convinced the next move is another cut, that in the short term at least, the concern of the labor market will be prominent and will push the Fed to put another insurance cut, if you want, here. The outlook for next year is probably a bit more uncertain.
Well, let me just follow on the Fed very quickly. Is this market or economists like yourself treating a deceleration in growth as the same as a prospect of recession? Should there be a difference between those two scenarios? And are you seeing that?
I would say our view is that the recession will be averted, but of course an important input in this view is that the Federal Reserve is reacting to the downside risks, and that help eventually, I think, to improve the situation. What we are seeing from the data is activity data are holding up very well. If you look at GDP, is very solid. On the other hand, the labor market is slowing, and as President Waller puts it, something will have to give. In our view, the labor market will catch up with activity data as a part of this, kind of more optimistic scenario about the prospects for the U.S. economy, the global economy more in general.
There's a picture where the ECB and the Fed diverge, and quite significantly, next year. Our own in-house economists, Bloomberg Economics, they see rates on hold for a prolonged period of time, but they think the bias, if there is one, is tilted towards a cut next year because of the trade impacts on the Eurozone economy. You disagree with that view. Why, Luigi?
Well, we agree on the first part, which is a prolonged period of rates on hold. And I think the message from President Lagarde yesterday very much reinforced this view. Seems to me that there is a high bar for a move in other direction in the short term. But if I look at the risks overall next year, I think the bias is actually for the next move to be a hike. Why is the case? Well, the ECB has got a forecast for growth of 1%. We think there is scope for upward surprises compared to these expectations. Actually, our view is for a growth rate of closer to 1.5%, given the fundamental factors I mentioned, but also the fiscal stimulus coming from Germany. And I think this will be more effective than many people tend to believe.
Because there has been reporting that this coalition in Germany is fracturing, at least to some extent. There's disagreement. The reform agenda has been slower than many would have hoped for Chancellor Merz, and that without that reform agenda, the spending is not going to be as impactful. Is there a risk that we're over-indexing on the fiscal spend from Germany without thinking about the reform agenda that is stalling?
I think there are two issues around the stimulus. The timing is very uncertain, and as you say, it should be accompanied by reforms. I saw a shift in terms of debate in a very encouraging direction. There are, of course, uncertainties there, but the size of the stimulus is absolutely massive. And this is also an important consideration. And at the end, I think some reforms will be implemented. And the impact, what economists call the fiscal multiplier, the ability of the fiscal stimulus to impact activity, will probably surprise to the upside. We generally put everybody some average numbers in our models, but I think the reality will probably surprise expectations to the upside.
It's fascinating that you're saying that, because you're not only the contrarian among economists who aren't really looking at a hike, you're a contrarian among some of the ECB voting members as well. I was in Madrid about a month ago, and we were talking to Governor Escriva there, and I had asked him, are we just taking a hike off the table? And he said it's not guaranteed that there's a rate cut, but a hike might not necessarily, having too much growth is not necessarily a prospect that Europe is used to. That being said, I'm curious, though, when you're looking at the inflation projections, the ECB is still talking about an undershoot in the first quarter. Wouldn't that minimize or offset any sort of inflationary pressures you're talking about?
Look, it's very much in the short term, and we agree. We have inflation going a bit below 2%. But let's take a step back here. We have growth more or less a trend, not far from trend, with inflation at 2, going slightly below 2, and then converging again towards 2. I think we are very much in a good place, like President Lagarde is suggesting. Now, the story seems to be that, they mention data dependency, meeting by meeting. But to me, this is very much to preserve some optionality, which in a very uncertain world is an asset. But the bar for moving is extremely high, especially if growth data start improving and surprise to the upside. And let's look at leading indicators recently, the PMIs, the German IFO. They are all suggesting some improvement, and I think this will continue into 2026.
Well, you mentioned a key set of data that has also been pointing to some weakness when it comes to the political uncertainty, specifically when it comes to the French data. And I recognize that yesterday some of the data out of France actually came in hotter than expected. But the general sentiment still seems to be that the political uncertainty and the lack of the budget pass-through is actually hurting the demand. Is there a bar for the ECB to get involved if we start to see spreads widen out more violently?
I think there is a bar. The bar is quite high. I don't think will be reached out in the short term at least. So our view is that the OTB bond spreads will be in a kind of very small trade range, over the next few months. Why? We've seen a significant shift in market pricing, which prices a lot of the bad news, and I don't see a catalyst for this to become a greater problem in the short term. I think that's the key point. Certainly, this will affect sentiment, and this is one reason why probably growth will be below trend in France. But I think this at the Eurozone level is more than offset by positive news coming from Germany, and importantly, the spillover effects the German stimulus has on other countries. Look at Italy, very strong manufacturing sector. Typically, a very strong correlation with the manufacturing activity in Germany. I think will also benefit from this fiscal stimulus in an indirect fashion.
All right. Luigi Speranza, Global Head and Chief Economist over at BNP Paribas Markets 360, joining us around the table and giving us a little bit of a world tour of the central banking picture. We thank you so much. Coming up on the program, Universal Music topping expectation, lifted by demand for none other than Taylor Swift and music from the hit film K-pop Demon Hunters. It's a shame Guy Johnson is not here to have this conversation. It's one of our stocks to watch next. This is Bloomberg.
We have some breaking data crossing the terminal right now. French CPI, French inflation, year-on-year coming in bang in line with estimates, 1% for the month of October, slightly below the previous print of 1.2%, but again, in line with the estimates. Month-on-month CPI for October out of France coming in at 0.1%. That's month-on-month, slightly higher than the previous month. There was a contraction of 1%, but then again is in line at 0.1% month-on-month, in line with the estimates. No huge move in the euro on the back of this. You're looking at 115 for the single currency, given that the data has fallen in line with estimates. Not a big surprise on that front. We were speaking, of course, about the relative strength of the French economy, 0.5% with most recent GDP print yesterday, despite the political uncertainty in that nation. Our previous guest of BNP Paribas seeing Eurozone growth potentially hitting 1.5% next year. The French inflation story then looking relatively benign, in line with estimates.
Absolutely. Lots going on, of course, in the European space. Doesn't move the dial, though, and maybe do we start to see more of it shake out going into next week. Let's look at a little bit more of a broader view on the markets and bring in our executive editor for Asia Markets, Paul Dobson, for a couple minutes on this macro story. Paul, positivity, is that how we're ending this week of geopolitics, earnings, and central banks?
Yeah, hi there, Kriti. It has certainly been a bit of a roller coaster ride, hasn't it? And I think that, in general, the Trump trip to Asia was pretty well received. Here, we've got not everything solved and definitely, kind of big questions to come down the line. But at the moment, we've got a truce, and that's pretty good for markets in general. Yes, there's been a little bit of a retrenchment in Chinese markets over the past couple of days, but that's after some big gains earlier in the week when we got a lot of the news and information that was likely to come from the meeting between Trump and Xi. And I think that Trump's other meetings around the region have also been seen as a positive. On the tech earnings front, been a bit of a roller coaster ride as well, hasn't it? A few ups and downs. I think that you've got a couple of takeaways that you can have from that. One, the market is going to become a little bit more discerning about getting some actual kind of return on all of the investment that the companies are going to be making and looking for that. I think that, there's still some strength there. We saw with Amazon in particular and Apple overnight that's lifted the market again, giving us that positivity. I think the other thing is the debt market loves it, right? So the really blowout demand for the bonds that were being sold to fuel some of this spending by Meta. So a few takeaways there. Samsung in Asia as well, big beat to the upside. So some positives coming out of it at the end of the week.
Paul, you're focused, obviously, a lot of the time on what's happening in Japan. The Japanese yen at 154.32 right now, down 0.1%. So trading at around, an 8-month low. The BOJ, of course, holding rates at 0.5%. Is this a bet that Sanae Takeichi will keep the BOJ on hold, essentially? How much weaker can the yen get?
Yeah, well, the BOJ always chickens out, to borrow a phrase from somewhere else. They had an opportunity to hike, but they haven't taken it. So we're still waiting for that next one to come through. And in the meantime, the outlook for inflation is starting to slow a little bit. So will they be able to get above 0.5%, which we haven't seen since like the 1990s, We're getting a weakening yen. We do have some pushback coming from the government. It's like the new finance minister, Katayama, has the phrase book. She knows to start warning when we get to here. It's only about level 3 here, so we're still some way off intervention. And we have hedge funds and forecasters betting that it will go to 160 from here because, as you said, there's that sort of subtle indication that the BOJ won't be hiking very rapidly given the change in government we've just seen.
Well, Paul, very quickly in our last 30 seconds here, can you just talk to us about the FX space, given that we are seeing these moves in the yen? What about the dollar? Are we done with the dollar weakness story?
Well, it depends what you're measuring it against. I think, on the gold side, the dollar has been very weak still and continues to plummet. But a couple of months of gains in a row for the US dollar, particularly against developed markets. EMFX is doing fine at the moment. Maybe with the Fed being a little bit more hawkish, we will see less weakness from now.
All right. Our executive editor for Asia Markets, Paul Dobson, walking us through the macro picture. The end of a very volatile week. We thank you so much. Let's go from the macro to the micro and get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with something light and fun this morning. Universal Music Group, which is the world's largest record label, has reported revenue that came in ahead of expectations, and that was because of two main things. First of all, Taylor Swift, and then second of all, the soundtrack to the hit film K-pop Demon Hunters, which is a film that I must admit I have not seen yet. But we could see that boost in the shares after what has been quite an uneven performance for Universal. This is also quite an interesting company that's been really trying to adapt to the new normal created by AI. So it's recently announced that it will be launching a new music creation and streaming service in collaboration with an AI music startup. So we should be watching for that development, and that's definitely a stock to watch moving forward as well. Moving on to Spain, and those Spanish banks have been doing pretty well. We've got two of them reporting this morning. So CaixaBank, which is the third largest Spanish bank, has upgraded its return on tangible equity forecast and also unveiled a 500 million euro buyback. And then Unicaja, which is a much smaller Spanish bank, has also boosted its net interest income forecast. So we could see those performing quite well this morning. As we can see, they've already been outperforming that broader banking index in Europe, and we could see them maintaining that outperformance today at the open. And finally, let's end with Defense and Renk Group, which is a German defense company that manufactures gearboxes for tanks, has been upgraded to a neutral rating at Citi. There's actually been a slight pullback in the shares recently, but the stock is still up, as we can see, 250% over the last year, and we could see that additional boost on the back of that upgrade. This is now a stock that has only a couple of sells, and the large majority of buys and the analysts are going to be focused on that capital markets day that's coming up in November, where they'll hear more about those medium-term opportunities for that group.
Thank you very much, Chloe Melly, with some of the stocks to watch. We'll have Chloe back, of course, in the next hour to see how some of those individual names move in the opening trade, of course, this Friday morning. Kriti, I know you want to touch on what we're hearing as well from one of the hawks on the spectrum when it comes to the ECB, Mattis Muller, talking and reacting, of course, to this week's decision to hold rates, and what we heard from Christine Lagarde and his views in terms of how things may evolve going forward.
I mean, we were just talking to Luigi Speranza over from BNP Paribas 360 about the risk of a potential hike that could come from the ECB. He was making the case that things could perhaps heat so much. He's getting validated, basically, but to your point, by the hawk. Mueller going on to say the government spending, which is the question you had asked about from Germany, can boost GDP, but can also boost prices. So it's interesting that that hasn't actually moved the Dow on the euro very much, but perhaps it's because he is a known hawk at the end of the day. Very interesting to see that is starting to be where the conversation is happening out of the ECB. Coming up, it is the opening trade. Futures weighting a little bit lower. This is Bloomberg. A few minutes to go until the opening trade across Europe. It kind of ended yesterday's session with a little bit of a Debbie Downer kind of syndrome. There's no other way to describe it. The stock 600 dropped to 0.8%. You saw the S&P 500 really follow suit to the point that you were down 1% on the U.S. index. Despite after the bell, you did have some positivity when it comes to like the tech stocks, perhaps some more optimism around where the U.S. and Chinese relationship actually stand. But it's interesting because we did end the day yesterday negative. When you look at the futures picture, it is going to be interesting because, again, it is Friday. You're going to see a little bit of a risk off ahead of the weekend. And that's perhaps why we're seeing Euro Stoxx 50 futures flat at the moment. Similar story over with the DAX. The FTSE 100 actually underperforming a little bit more. I wonder, Tom, how much of that is a rotation, given that we did see the FTSE 100 outperform earlier in the week.
Let's check in on some of the stocks that could be moving at the open, of course, as we count down around 50 seconds from that moment. Renk is raised, the defence company, of course, raised to neutral at Citi after a drop to near value. So we watch that stock on the back of the change, of course. CaixaBank announcing a 500 million euro would be quite something, 500 million euro share buyback. Of course, the Spanish lender. So we'll see if that moves on the back of that return of cash to shareholders. And UMG as well. Results lifted by Taylor Swift and the demand for her new album, of course, as well as the Netflix hit Demon Hunters. So UMG in focus as well. Very different story there. Some of the stocks that we were focusing on, some of the individual potential movers, Kriti.
Yeah, it's going to be a fascinating one. I feel like because it's Friday, it's Halloween, everyone wants to go home, it's kind of rainy outside. Maybe that does mean we're going to set ourselves up for a lower open. But then again, there's plenty of positivity out of the States overnight to actually price into these markets. So So let's see how the European trade actually opens. Here we are. The FTSE 100 kind of wobbling around. There's no other better way to put it. Again, I finally feel like it's a sleepy feeling. Everyone's just excited to go trick-or-treating. I think that's the takeaway from today's market. I am excited to see what the IBEX does, though. You do have a couple of interesting stories. You mentioned the banking sector, Tom. I think what's crucial as well that Telefonica has just talked about a dividend change as well. So there's a lot going on in the Spanish market, a couple of earnings, a couple of deal news, and of course some buybacks there to price in. The Stoxx 600 overall, though, taking a little bit of a back seat. And now, of course, you have the CAC and the DAX. Again, these markets are giving me nothing, Tom. Rescue me.
The FTSE 100 is down 0.2. But let's look at the individual sectors then. I'm sure when we come to some individual names as well, there will be some interest there for Kriti Gupta. Health is currently your top sector, up 0.2%. Very modest gains coming through. Auto is also getting a bit of a lift, up 0.2. You're seeing the DAX over in Germany, of course, tilted towards that sector at 24,000. Largely flat on the German index. This is not helping Kriti Gupta. On the downside, construction is the biggest loser right now, down 0.6%. And interesting, the read across from the tech optimism stateside not coming through for the tech sector here. Of course, there was a significant sell-off in the Nasdaq 100 yesterday, concerns about Meta and to some extent Microsoft as well. But then you had the earnings coming through from Amazon and Apple, and the US future story is pointing significantly more positive, looking to pair those losses. Nasdaq 100 is up 1.3%, but that read across from the futures picture stateside when it comes to tech is not being reflected in European tech. That sector is currently down 0.5%, Kriti.
Yeah, I think it's fascinating. What is rallying this morning, though, is we are seeing a lot of the healthcare names get a little bit of a bid. Novartis, for example, is your biggest index contributor to the upside. From a sector perspective, higher by 0.3%. You're seeing like Novartis, Sanofi is a bit higher as well. But to your point, Tom, you are seeing perhaps some of the outperformers, again, earlier from this week, the tech, the banks, they are starting to rotate out. And again, the healthcare names weren't doing so well earlier this week. They are starting to rotate in. I feel like when it is a boring, lackluster market as it is right now, it is easy to blame the Friday energy. Let's get maybe a little bit more analysis here. Anne Milletti joins us around the table. She, of course, is the head of equity investments over at Allspring Global Investments. We thank you so much for joining us on this Friday. I mean, rescue us. How should we be thinking about these markets going into next week?
You know, I think it's an interesting time because there's an odd barbell effect going on in the U.S. markets. And it's those large cap names that are really outperforming. And then on the other side of it, small cap, which is really strong. But there is some differences. In the large cap space, you have some companies with solid fundamentals, increasing revenue, increasing earnings. On the small cap side, what is outperforming the most is that low quality, the non-earners. And that, while I like small and mid cap names, and we can talk more about that, that appears a little bit dangerous given where we're at in the market cycle. Buying companies with not great fundamentals long term is kind of a short term trade, not a long term investment.
So does it, I mean, let's just take it piece by piece here. It feels like everyone's talking about the earnings picture, specifically out of the United States. 6 months ago, we were worried about margin compression. Is margin compression not an issue anymore?
I think there's still a question mark out there. I mean, the tariff concern, interest rate environment, all of that makes people concerned about whether or not margins are sustainable. I think there's promise with, technology, productivity improvements coming. That's a promise. Also, we've seen companies adjust really well to the tariffs. I mean, everybody expected this to be a much greater impact than it has been so far. And so I think margins even remaining stable is good for the market. And over time, if you see a little bit more margin creep up, that's going to be positive.
When it comes to the small cap story, and you're talking about that barbell picture that we've seen in the markets, to what extent is that predicated on an assumption that there will be additional and significant cuts from the Federal Reserve? And if there's a pause in December, how much of a challenge is that to that narrative, that theme?
Yeah, Tom, I think you hit the nail on why that tail end of the small cap have really outperformed. It's been a play on the rate cycle going lower. And so when there's fear about whether or not we're not going to have as many cuts, there's more risk to that tail. What I'm optimistic about is I'm fairly optimistic about growth for 2026. And if that continues and the rate cuts are fewer because growth is better, that's still a great environment for small caps. And so, but the higher quality small cap names.
Okay, let's move from the small caps to the mega caps and some of the tech names. Where do you look beyond the very obvious tech winners at this point. What is the opportunity that investors can be thinking about in terms of adding to their portfolio if they remain optimistic on AI?
Yeah, look, we're really optimistic on this innovation cycle, AI in particular, but our portfolio managers are starting to take the next level approach. What's next? And if you think about all the names that kind of have been not ignored, but silently and slowly following the gains that these the mega cap companies have had, there's some really interesting areas. I mean, you all talked about healthcare a little bit. That's an area where there's good opportunity. It could take longer to see the productivity improvements, but the healthcare system I'll just say it's broken in the U.S. and it is ripe for innovation. And so our portfolio managers are looking deep in there. They're still involved in technology. It's a big space, but outside of the hardware companies, what's going to be the next part to really advance and look good? And software is sold off dramatically. I think there's some areas of software that continue to look really strong.
But is that baked into, is the AI theme, is that modernization you're talking about baked into every company that is leaning into it? I mean, I'm just taking the example of Deutsche Telekom here, or Nokia even, or even some of the smaller European names that haven't seen the same AI premium that you've maybe seen in the United States. Is that a European thing, or is that a small cap size thing?
I mean, I think, when you asked earlier about margins, I think that's kind of the key focus for, the answer to the question. Where are the margins sustainable and where could you see margin growth? And those are the areas of the market that our investment teams are really, really focused on, and big believers that the innovation cycle and the right spend could lead to greater revenue growth and greater productivity over time.
When it comes to the energy picture with relation to the tech story, should there be a stronger correlation there? We talk about it all the time. Yes. But you're not really seeing that in the way things are trading.
No. Again, I think about the energy market. I have followed energy much more closely early in my career, but it's supply and demand. And, while you can be very excited about the energy demand coming from AI and what is needed for the infrastructure, you see a lot of supply coming on the market. And, again, we'll have to see what global growth looks like. But if global growth is strong in 2026 and you have this extra demand coming from the infrastructure side and what is needed for AI, et cetera, in the future, the environment for energy could look much better than it does in this moment in time.
We've been focused on the APEC summit as well, and that brings us to the EM conversation, emerging markets, and the lift, frankly, that's come through from weaker dollar in 2026. Is that something that is sustainable into 2027? Into 2026? Sorry, the gains that come through 2025. I'm already in next year. How vulnerable is EM on a turnaround in the dollar story? And what assumptions are you making about the greenback for next year?
Yeah, I'm quite optimistic about EM. And look, we were optimistic heading into 2025. It worked out I think, primarily for the reasons you talked about. Dollar weakness really gave the tailwind for EM. The next phase of that, the EM outperformance that we believe can happen in 2026 is even if you have a stable dollar, which I think I'm kind of in the camp of, you'll see more stability, you'll see some trades up and some trades down, but overall a flat dollar. That environment's not bad. It doesn't produce a strong headwind from EM from this point. But the fundamentals for the EM stocks are getting, again, brighter. There's a lot more focus on AI and all the materials that are needed to go into AI that come out of emerging markets. And so the picture of the companies that you can invest in emerging markets looks different today than it did a decade ago. And then lastly, there's just an under-allocation of global assets into EM. It's only 5% today. That's down from 7% just a few years ago. If you just get back up to, and 13% I think at the high, if you just get back up to 6%, it's over $500 billion that has to flow into EM. That's a lot of money that's sitting on the sidelines waiting to see if it's real.
Okay, so that's the 5% exposure to EM versus 7% historically, at least in recent precedents. What about the flow show into European equities then for 2026? Where are the opportunities there?
Look, I think international markets still provides good opportunity. It's a little harder with the developed countries to see where you're going to get that strong growth. Is it going to be from Europe? Is it going to be from Japan? Is it going to be from those places? We're still optimistic about international, but again, if I had to pick one over the other right now, EM seems like a little bit more solid of a trade.
Wow, that is quite the call. Anne Milletti, head of equity investments at Allspring Global Investments. We will leave the conversation there. We thank you so much. I'm putting my Guy Johnson hat on today and taking a look at his core six, of course, the heavyweights that tend to move the European market. We're really got an eye out to see whether the optimism aftermarket in the U.S. is going to bleed into Europe. And by this indication, the answer is no. ASML down about 0.7%. Schneider Electric moving lower as well. Seeing some, I don't know if optimism is the right word. This feels like a defensive trade to me. Nestle higher by 0.2%. Risk off, it seems, across the board. But again, these were the names that rallied quite significantly earlier in the week. So maybe just, again, letting out some steam ahead of the weekend. Let's get a check on some of the other individual stocks on the move. Chloe Melly has that for us. Chloe.
Good morning, Kriti. We have got some positive movements across for Universal Music Group. So it is up almost 1% this morning after reporting a revenue ahead of expectations, thanks to really strong sales of Taylor Swift's new album and also a strong performance for the Netflix hit K-pop Demon Hunters, and the soundtrack there performing really well. So it's quite a relief for investors in Universal after some weakness in the stock over the last few months. Moving on to Renk Group, which is also moving higher this morning. The German defense company is up 2%. It makes gears for tanks, and it has been upgraded to a neutral rating at Citi, and that is following some retreat in the shares recently, which means that now it is trading near fair value according to the analysts, and we are therefore seeing the stock up 2% this morning. Moving on to Saint-Gobain, which is the French company that makes building materials. It is down this morning. We are down almost 2% after reported sales that missed estimates over the third quarter, and that is because of quite a weak performance in North America, despite some resilience in Europe, which is quite worrying for that kind of key market for Saint-Gobain. Moving on to Score, which is an insurance company. It actually managed to swing back to profit after a loss, but the earnings seem to have disappointed. We are down 4.7% this morning for Score. It might be because the gross written premiums came in below expectations, but it seems there was some disappointment in those earnings for investors this morning. And finally, Sainsbury's is also down after being placed on negative catalyst watch by Citi analysts ahead of the results that are coming next week. And that is because there's probably not going to be a guidance upgrade, and that will probably be leading to some weakness in the shares when they report next week. So we are down 1.4% for Sainsbury's this morning.
Chloe Melly from our equity team. Thank you very much indeed, with some of the stocks on the move this Friday morning. Coming up, a frantic 4 days for Pfizer as Novo tries to crash their deal for weight loss maker Metsera. That is next. The countdown is on. This is Bloomberg.
Welcome back to the opening trade. 16 minutes in today's session, and we are already seeing the Debbie Downers, is what I'm going to call it. You are seeing risk sentiment turn over a little bit. The DAX and the FTSE seem to be your underperformers, but only down by about 0.3%. It feels like a little bit of the momentum is being taken out of this market. But, of course, some of it is also being driven by the heavyweights, especially in the healthcare space. Let's go to that story next. There's a showdown when it comes to the obesity drugs market. Novo Nordisk has upended Pfizer's deal to acquire obesity upstart Metsera. Now, the U.S. pharma giant now has 4 days to trump Novo's bid or walk away. We can get the latest on this drama with Bloomberg's Ashley Furlow, who joins us around the table. Just big step back here. Why is Metsera so in demand?
So every company who is not in the obesity space needs to get in the obesity space. Pfizer's not there yet. They really want Metsera. Novo Nordisk, in the obesity space, people are not so sure about the pipeline. They need this big bet. But for Pfizer, this is particularly important. Post-COVID, we've seen the shares down. It's sort of down around 60% from those COVID highs. CEO Albert Bourla is under a lot of pressure to prove to investors that it has the pipeline. Metsera was sort of going to solve that problem, and they actually had a pretty good price for it. So we know in the previous negotiations, Pfizer was actually a lower bidder, but because of concerns about regulatory issues with another bidder, which we're all assuming is Novo. Pfizer beat Novo. We're assuming it was Novo to the initial deal. Now, obviously, Novo's come in with a higher bid, and Metsera is saying, we'll accept this, and you have 4 days to counter-offer.
OK, so the clock is very much ticking, 4 days, and we'll see if Pfizer comes through with a counter. Given your understanding, your experience analysing, looking at this space, who do you think is best positioned at this point? Are Pfizer going to go all in on trying to lock in Metsera, given, as you say, they do not yet have an obesity drug proposition?
So if Pfizer raises their bid, I think analysts are pretty sure that it could have a pretty good play here. The issue is it seems like Pfizer's kind of going on the offensive. They're really saying, pointing to anti-competitive issues, saying that, you're trying to take over an emerging American competitor. So that if they try to play the American angle, sort of the anti-competitive angle, that might make it harder if they're not actually willing to put more cash on the table, which at the moment we're not really sure if they are willing to do.
Can you just, and again, I think it's so fascinating here that they're kind of leaning into this nationalism piece, especially because Pfizer, my favorite fun fact about Pfizer is that at one point 60% of their revenue was coming from the COVID vaccine. So their diversity push in terms of their pipeline is really fascinating. But I want to come back to that U.S. kind of take when it comes to healthcare and the pharmaceutical space. Where are we on that relationship, given that so much of, especially the obesity market, is driven by things that are not in the U.S.? Where are we on that rate, on things getting cheaper, on that dynamic?
So interestingly, obviously, Pfizer was the first a drug maker to agree a deal with U.S. President Donald Trump. So, they already have that in with Trump. They have a long relationship during the pandemic with Trump. Many companies are already agreeing to manufacture many more drugs in the U.S. They're agreeing to drop prices in the U.S. They're agreeing to sort of, give sell drugs directly to consumers rather than going through middlemen. Yeah. Everyone's sort of coming to the table and saying, look, President Trump, this is what we'll do to make it easier and make it cheaper for Americans to access new medicines.
OK, Bloomberg's Ashley Furlow, thank you very much indeed on the Pfizer-Novo standoff around Metsera. 4 days to go, and we'll see if Pfizer responds with an upped bid, of course. Thank you, Ashley, for the update on that front. Let's switch focus to the oil sector right now, because oil is heading for a third monthly drop on concerns of a global glut. Those fears could be confirmed this weekend, with OPEC Plus expected to back another supply hike. For more on this, let's bring in Bloomberg's Germana Pesecci with the details. Germana, give us the outlook then as we count down to OPEC Plus this weekend. Expectations, maybe they put more oil on the market despite the softness in oil prices.
That's exactly it, Tom. So the expectation is that OPEC Plus, when they meet again this upcoming Sunday, will decide to put back extra barrels to the market, but to the tune of around 137,000 barrels per day. So slightly slower than the pace that they've been running at over the course of the summer. And also, just as a reminder to everybody, over the last few months, OPEC Plus have actually reintroduced a targeted amount of 2.2 million barrels per day. I say targeted amount because in reality, the actual production that has hit the market has been slightly less. But nevertheless, I think, from here onwards, the focus for the market, especially on back of the price action in oil over the last couple of months, is on what this extra production actually means to supply and demand. And most analysts out there are anticipating quite a big supply glut to come in the coming months. Bloomberg Intelligence anticipating a supply glut of around 900,000 to hit in the fourth quarter. IEA estimating a supply glut as big as 2 million by the first half of next year. And so what you are seeing now is the market reacting to fundamentals. That being said, over the course of the summer, we did see strong seasonal demand kick in, which is one of the reasons why, despite the extra oil, we still stayed above the $60 target. And the second big question for investors is China's strategic stockpiling, because that has continued throughout the course of this year. Our own Bloomberg Intelligence estimating that China's strategic reserve capacity are now sitting at 95% full. So we are getting to a point where you may start to see that demand from China beginning to level off as well. So all of these are matters that the OPEC Plus group will have to think about when they meet on Sunday.
Well, talk to us about how the geopolitics factors into all this, Germana, because we've seen quite a bit of volatility when it comes to the price of Brent. There's been some questions around whether the purchases of energy from China into the United States could be factoring into this, how the relationship between the Saudis and Russia are factoring into this. For you, What has been the driver in the conversation?
Look, I think one of the main focuses right now is what is exactly going to happen to that Russian oil. With the two companies, Rosneft and Lukoil, they were targeted by the Trump administration. They account for about 50% of Russian oil production. Already, we are seeing signs that Indian oil refineries are beginning to divert away from Russian oil. The summit that took place between President Trump and President Xi actually did not discuss the subject of oil, though India and China remain the biggest buyer of Russian oil at this point. But so when you think about how that could impact the oil market, if that Russian supply were to come off in any shape or format, then you would have to think other producers will come in. And that is where OPEC Plus could come in if they want to. But perhaps the reason that they're being cautious here also is, let's not forget, Russia are a member of OPEC Plus as well. And Russia have been pushing for slower incremental production putbacks on one point. And the second thing to bear in mind as well, from a geopolitical perspective, is the Saudi Crown Prince is heading to D.C. later this month. Obviously, we know that President Trump wants to keep a lid on where prices are. And so maybe OPEC Plus and Saudi Arabia leading them at this point in time will want to keep a little bit of spare capacity in case there are other shocks to the system at some point in the future, so that they can lean in to that spare capacity. So yes, geopolitics is a big focus, but at the same time, there's no need to rush into putting back extra supply to the market, given the uncertainty about the months ahead.
Okay, Brent currently just below $65 a barrel on Brent, $64.97. WTI at $60.44. Bloomberg's Horizons anchor Jemana Pasechi on what to expect and the implications of that OPEC Plus meeting and that decision expected this weekend. Jemana, thank you very much indeed. Horizons Middle East anchor, of course. Let's check in pre-market then. The US, a couple of significant names in the tech space, of course, and this is lifting the Nasdaq 100 futures. Apple coming through with strength, particularly the predictions around the holiday season and demand for the iPhone 17. The quarter on which they reported only included about 2 weeks of iPhone 17 sales. The expectation is that the holiday season will be strong, offsetting concerns about a bigger than expected slowdown in the Chinese market. Amazon, AWS, the strength there really performing very well. 20% increase quarter on quarter for the leading cloud provider, of course. And look at the shares in Amazon, called higher by more than 12%.
You know what the best part about the holidays is, I think, in my opinion, is the cheesy movies, like the Hallmark, the Netflix, Christmas movies, where, you know, they always end up together under the mistletoe. It's a really exciting time of year, I think, for Netflix. Nevertheless, that's not what's boosting the stock. That's just my own personal opinion. Shares are higher because they are announcing for a 10-for-1 stock split. I mean, this is natural here. They are saying it's going to benefit employees. Shares higher by about 3% in the pre-market. I mean, just look at that stock price, $1,124 for Netflix. There's also some rumors that they may be involved in some M&A. Reuters talking about a bid potentially for Warner Brothers Discovery amid the broader media consolidation story in the States.
Yeah, there you go. That's why you need the stock split, given the pricing right now on Netflix. Switching to another part of the tech space, Cloudflare. This is Cloudflare. This is a company that focuses on things like security, data security, cybersecurity. Fourth quarter revenue forecast beating the estimates, called largely unchanged right now. But in terms of the cybersecurity space, Cloudflare potentially one to watch at the US Open as well. Currently, Nasdaq 100 futures pointing higher by 1.1%.
Yeah, it's a fascinating one. We'll see if this kind of momentum actually sticks. And we should just mention that Jensen Huang is still making comments, of course, in South Korea. And Nvidia shares are higher by about 1.9% in the pre-market. Coming up, we are going to, of course, dive into the earnings story, but we're going to put it in the broader context of how it squares with some of the other geopolitical issues, including the supply of critical minerals and rare earths. We have a fantastic conversation ahead. Stick with us. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. It was a challenge session on Wall Street yesterday with losses on the Nasdaq 100 of more than 1%. Question marks about the spend coming through on CapEx from the likes of Meta. US futures looking a lot more positive today, but European equities still trying to find the direction. A bit of a softer picture yesterday as well. Today, down 0.2% on the benchmark Stoxx 600. The German DAX is off by 84 points. You're seeing the FTSE 100 here in the UK down 0.3%. And over in France, a little bit more stability, off just 8 points so far. But it does seem on the back, of course, of a huge week when it comes to the central banks, with the Fed cutting by 25 basis points, but putting a big question mark over December, the ECB on hold, and the earnings story coming through. The equity markets here in Europe looking for the next catalyst. Kriti.
A little bit of a mixed market picture when you look beneath the hood, one layer lower. Let's talk about the members higher and lower. Higher 253, lower 318. But again, take this with a giant grain of salt because the volume is down about 26%. Everyone is getting ready to trick or treat tonight. I think that's my theory here. Let's talk about what some of the other individual movers are and your leaders and laggards for the session. This is one that we haven't talked about a lot. AB and InBev has been having a massively volatile week, higher by 1.2%. It was one of the biggest movers in yesterday's session as well. So keep an eye on that. The banking sector, we've been talking about the blockbuster beats from SocGen to Santander to name your bank, Standard Chartered among them. Danske Bank and Erst also getting a late boost in this kind of trade towards the end of the week. Let's talk about the laggards, though, because as Tom said, the risk sentiment is to the downside. And you are starting to see some of the pain here. We were talking about the tech theme, that tech outperformance in the States, not necessarily bleeding into Europe. I think this is a great example of it. Prosus down almost 3%. Deutsche Telekom had gotten that a little bit of a boost earlier in the session, earlier in the week, I should say, with that partnership with Nvidia, now down about 1.3%. Some of the momentum coming out of this market. A similar story for AXA, down about 1.5%, Tom.
OK, here's what else you need to know. This Friday morning, Bloomberg has learned that Telefonica is set to cut its dividend as part of a new strategy plan due next week. The Spanish carrier has one of the highest dividend yields among European telecom operators, and its new policy aims to align it with peers, strengthen the balance sheet, and signal commitment to financial discipline. China's factory activity has slumped for the longest streak in more than 9 years, prompting fresh calls for greater policy support even as the country reaches a trade truce, of course, with the US. And Nvidia has forged a landmark deal to supply its technology to South Korea's biggest companies, part of an aggressive push to expand AI infrastructure around the world. Under agreements brokered with the country's Ministry of Science and a trio of corporations, Samsung, Hyundai and SK Group, Nvidia will be supplying more than 260,000 of its accelerator chips to help jumpstart Korean AI projects. Kriti.
Well, Tom, speaking of that partnership, we should mention that our very own Sherry An is on the ground right now at the APEC summit. She is speaking to Jensen Huang. You can see a shot of him there. Of course, we will bring you the news as we get them, now covered by the camera. But don't worry, that conversation is very much happening. We should mention, of course, we are seeing Nvidia shares actually higher this morning to the tune of about 2%. He was on stage earlier at the APEC summit to say he was already looking ahead to the next generation of AI products.
This year, AI became profitable. And when something becomes profitable, you want to manufacture more of it. Just like when you're manufacturing chips and wafers and DRAM, if the manufacturing of those chips were profitable, you want to build more factories to create more chips. Now that the AI is profitable, we want to create more factories to generate more AI.
Matt Bloxham of Bloomberg Intelligence has, of course, been following this story. He joins us now. Nvidia is just on a world tour of deal-making and partnerships, it seems. Is this the peak? Are we at peak Nvidia?
Good question. But I mean, I think it's a great strategy. You know, I think clearly there's a lot of runway to go yet with AI, but at the same time, the rivalry is picking up both from the US and from China. And I think this makes complete sense for them to be getting themselves embedded in as many technology industry partners as they can, but also as many vertical sector partnerships as they can, so that really you're at the kind of ground zero with the technology. And once people are locked into your technology and they commit to it, it gets very hard to unpick that and bring in rival technologies. So I think it's whether there's an AI bubble or not, this is a great strategy to kind of make sure you're going to benefit as much as you can from the opportunity.
And Matt, it was talking as well, Jensen Huang, about the CUDA software platform that they use that integrates with the hardware as well. And as we think about locking customers into ecosystems, I'm thinking of Apple as well, which historically has done that. And they came through with results a little bit softer in China, but they're forecasting a strong holiday season. Apple performing relatively well, given that they're not winning on AI at this point, and they face some supply chain and tariff challenges as well.
Yeah, that's right. And it's all about the iPhone again. You know, it's about 50% of their revenue. I think that the 16 last year was a bit underwhelming because it really didn't change very much and people held on to their phones. What we've seen now is that the 17, again, not perhaps a big technology change, but I think people have had their phones long enough that they're running out of battery, they're running out of storage, and this was the trigger for them to upgrade. And people are upgrading to the more expensive phones, the Pros and the Pro Maxes. And I think even in China, the messaging is that whilst sales dipped in the September quarter, the December quarter is going to see a return to growth. And overall, they're talking about a 10 to 12% growth in iPhone sales in the December quarter, up from 6% in the numbers they just reported. So, yeah, really encouraging signs there on that core product for them.
OK, Matt, thank you very much indeed. Matt Bloxham of Bloomberg Intelligence, of course. And as we think about the tech space, we have to think about what's happening in terms of the supplies of raw materials into some of this key hardware, rare earths, of course. And what a week it's been in terms of the deal, at least temporary, when it comes to the US and China. Rare earth minerals then are critical, of course, to big tech, as we mentioned, and central to the trade tensions between Washington and Beijing. Appian Capital Advisory is one of the few private equity firms dedicated to the mining sector and is making a big push into those critical minerals. Joining us now is the company's head of global affairs, Dominic Raab, also former UK Deputy Prime Minister, of course, and Foreign Secretary, so well-versed to talk about this. Dominic, thank you for joining us in the studio this morning. I know you're launching a new fund as well, so we can get into the details of that, but I do want to start on the news of the week and this reprieve, it seems, around these export controls and this system of licensing that China's put into place being delayed by 12 months. Some of the controls are still there, but the framework that really concerned some of the global manufacturers in the US as well has been delayed at least for 12 months. How much relief should we take from that?
Yeah, but certainly a measure of relief. I think people want to see these export controls lifted and the wider trade tensions ebbed. And the reason being is you've got exponential demand, particularly for heavy rare earths, but also for critical minerals across the board, and these bottlenecks in supply. Just to give you some sense of what that concentration in the market looks like, if you include refining and processing, Chinese control is upwards of 90% plus. And so, notwithstanding the progress, I think the central message for investors is, can we attract the patient capital to build up those alternative supply chains in critical minerals, and in particular heavy rare earths, everything from industrial and tech through to national security applications. And I actually think the impetus for more investment in that space is only going to grow.
What are you hearing from investors then? Are they waking up to this? Are you seeing more capital flowing into this space? Where's it coming from? How much momentum is there?
Well, look, there's a big challenge with supply. There's a good question around the awareness of OEMs to this challenge. We need to bring them on board. You saw that a little bit with the Mountain Pass deal, which was the most recent heavy rare earths investment that the Department of War, the Pentagon, made. But that brought Apple in, so that was quite interesting. But it also involved a floor price at something like double market value. That's quite a significant level of state intervention. How scalable will that be? We'll see. But certainly we see huge opportunities in this space. We've got one asset, for example, in the context of Australia. And of course, there's been this US-Australia critical minerals deal that was done about a week ago. Well, we've got one asset which can produce globally something like 7% of necessary supply of heavy rare earths. There's an interesting piece as well as the onshoring in the US around friendshoring. That's the kind of investment we think that would probably be part of that conversation.
Well, you mentioned Australia. This was also a piece of the commentary that's come out of the US and Japan's negotiations as well. There's a conversation in Washington right now that the United States can find alternative sources of rare earths to limit and even completely offset that dependence on China. Is that a fair argument? Are there enough sources around the world to offset that dependence?
Yeah, it's a great challenge. Look, we've seen the concentration upwards of 90% if you include the refining and the processing. My advice has tended to be, when I talk to international institutions or governments, onshore when you can, friendshore when you must. And Mountain Pass is a good example of the kind of deal where, OK, you can onshore, but that's not going to provide all your needs. If you're looking outside the US and global supply, interestingly, 37% of the natural resource available for rare earths can come from Brazil or Vietnam. I think interesting in terms of the trade discussions we've discussed, but also in terms of partners, so-called non-aligned partners that could be brought into the mix. And then you've got Australia, high trust partner, member of the Quad, member of the Five Eyes Intelligence Alliance, and then we've got this asset that can provide 90% of potential global supply. The question is, how do you make the best of that? What's the right mix of onshoring and friendshoring? Where do you do the processing?
So we've talked about the Americas, we've talked about APAC. Let's bring it right back to where we are, right here in Europe. I mean, how does the UK get their hands on these critical assets?
Well, we engage a lot, and I've been to Brussels a number of times this year. I think you interviewed me when I was over in Brussels.
Yeah.
Look, there's lots of plans being articulated. The West as a whole is something like 20 years behind China. We're seeing a lot of ambition under the new Trump administration, and there were previous initiatives under the Biden administration. I think it's fair to say Europe is a little bit behind, but they're starting to articulate plans and projects. I think two things. One, they need to turn those strategic frameworks into operational delivery. And secondly, certainly with respect to the European Union, and we have good engagement, there is still this Henry Kissinger question, who do you call? And who is actually driving forward the delivery of those supply chains that the industrial base in Europe needs?
Dominic, I think it's interesting as well, given your background with the Conservative Party, you're a champion of the free markets. But in this case, you say the state does need to intervene, and you're quite clear on that. Particularly when there's one thing about digging the rare earths out of the ground. The other is about refining capacity, and clearly China has the tech there, but also they're able to take on the environmental hit and the cost of labour and everything else that goes into refining these rare earths. So clearly, government support is essential at this point. Is that fair to say?
I think so. Look, if you compare the last big geopolitical commodity crisis, 70s OPEC, concentration in the oil market at that time was between 11 and 26%. That was regarded as fairly heavily concentrated. Now you're talking 60, 70, if you include refining the process, upwards of 90%. So I don't think anyone, even pure free marketeers like myself, would argue it's a free market. The challenge is, what are the ingredients for a solution to the alternative supply chains? Cost of capital for investors, that's a big issue. And we're seeing that with these innovative floor prices on top of subsidies and grants. How can you forge best-in-class public-private partnerships? The International Finance Corporation partnership with Appian, up to $1 billion in non-OECD countries. High ESG standards is a good example of that. Lowers the cost of capital for investors like ourselves. High standards of ESG. We want to make this a race to the top. And then you've got this wider piece around friendshoring and onshoring. And I think that you'll see both Europe, the US, Australia, Canada look towards what I consider a hub and spoke model, which is, as I say, onshore when you can, but be willing and agile enough to friendshore when you must.
This is a crucial conversation and absolutely central to so many different industries. Let me indulge in one question about UK politics, though, Dominic, given your previous role as Deputy PM and Foreign Secretary as well. Does your Conservative Party survive into the next Parliament? Should they think about a merger with Reform, given the pretty dire polling numbers?
Look, it's really a tough field at the moment. I'm going to leave those questions for Kemi Badenoch.
Do you have faith in Kemi Badenoch as leader of the Conservative Party?
Look, I'm not actively involved in politics, but you're right. It's a tough situation. I work very closely.
You're a big player, Dominic.
Sure. I'm reborn again in my investor role. But look, I work very closely with Kemi. I think she's a formidable talent. It's a difficult time, and you're seeing this fragmentation of politics across the board. You're seeing it in Europe, you're seeing the polarization in the US and in other parts of the world. The question is who can knit a path forwards, and it's no easy challenge.
Dominic Raab, reinventing himself right here on the opening trade. Head of Global Affairs, of course, Appian Capital Advisory, giving us his take on the UK, Europe, and, of course, the rare earths conversation happening around the world. It's dominated the markets. We thank you so much for your time. Coming up on the program, Jamie Dimon has conquered Wall Street. Now the question is, who will succeed him at JPMorgan? That's the focus of our Bloomberg Weekly Doc. Coming up next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 48 minutes into today's session. European markets are down across the stock 600 benchmark, down 0.2%. Bit of a brighter picture, though, in Italy. The FTSE move up 0.6 and the AIBEX up 0.5. But over in France, the UK and Germany in negative territory. Now, with a $4.6 trillion balance sheet, JPMorgan is more valuable than its three biggest rivals combined. And much of the bank's success is arguably due to its long-time leader, Jamie Dimon. But talk of a successor now has many wondering who could fill his shoes. A question Bloomberg Originals has explored this week.
The name of the game in American capitalism, especially American financial capitalism, is being big, and no one is bigger on Wall Street than JPMorgan Chase.
How big is it? With a $4.6 trillion balance sheet, it holds around 20% of all the money in the U.S. banking system. JPMorgan is more valuable than its three biggest rivals combined.
Last year, JPMorgan earned the highest profit in the history of American banking. They became the only bank to ever crack $50 billion in profit. There are a few different ways that you can measure a bank's success. You can look at profit, market value, asset size, but there's also staying power.
There is essentially no figure in the history of modern finance who has won power and kept it like Jamie Dimon.
Jamie Dimon is a great banker. I think he's been the head of JPMorgan for 17 years, something like that.
This country is a lot better off because Jamie Dimon has been running JPMorgan.
But the success of Jamie Dimon and JPMorgan casts a long shadow.
When you think about it, it's more of a question mark than an exclamation point. What is going to happen to this gigantic bank after its longtime CEO leaves? No one really knows.
You can watch the full documentary on the Bloomberg terminal, of course, Bloomberg.com. There have been plenty of suspicions of who might take his spot.
Speculation, a lot of speculation.
Yes, exactly. There's a lot of contenders. It's a big bank, as we just heard as well. But he says he's not going anywhere for a little bit. So there's some time to figure it out.
Well, the riposte has always been from Jamie that he's got another 5 years. And every 5 years he says he has another 5 years. We met him when he was here for the JPMorgan Tech Summit. He bounced into the room full of energy. So it doesn't look like he's slowing down in any way. And they've just opened this huge and pretty impressive headquarters, of course, in New York as well.
Yeah.
So the ambitions there with that balance sheet and with that most profitable bank in history being notched up in 2025. What a year it's been, but clearly some very valid questions about who takes over given the scale and just the ambition and the success that Jamie Dimon has had at that bank.
Yeah, absolutely. He's also, I've got to say, in full stride in terms of making comments about where we are in this market. I feel like his latest comments around the credit cockroaches have really been one that have taken everyone by surprise. You've seen several banks, we've certainly had those conversations here on the show, really address some of those concerns about whether or not this is a credit market that is healthy. This is, of course, with the backdrop of the continued fallout from First Brands and Tricolor. Take a listen to what some of the banking CEOs on this side of the Atlantic had to say.
The thing about fraud is you wonder whether it is one bad actor or it is some effect of circumstances that are stretching the company's finances and making them take risks that they otherwise should or would not do. That's the kind of thing we look for.
This was something that was deemed to be correct. So I think that there is a little bit of witch hunting and trying to compare things between one bank or the other and one strategy or the other is totally inappropriate.
Listen, we don't give any color on names on clients, but it is just one file that we have been impacted, and it is not a usual suspect.
There is nothing structurally that suggests that asset quality will be under pressure. Obviously, there are some talks about some sectors, industries. In our case, the exposure we have to non-bank financial institutions is less than 1%.
We are reducing, if anything, our exposure towards credit cards and personal loans in order to reinvest more in our wealth management.
It sounds like you're not seeing cockroaches in your portfolio.
Nothing moving right now.
All right, nothing moving right now. I mean, clearly, the auto sector, particularly when it comes to the subprime part of that in the US, is challenged. You've seen an increase in delinquencies. And so the question is to what extent it's just ring-fenced around that particular part of the US economy, as clearly banking executives are feeling the heat in terms of making sure that their portfolio is being scrutinized and how much exposure they may have. But credit spreads remain still tight, Kriti.
Yeah. everything's fine. Everything's fine in credit is what we keep seeming to hear. I think what's interesting, though, is that ultimately there are going to be some bad eggs here and there. That is a function of the growing activity you're seeing in the credit space. I think the bigger problem is that you're not only seeing issues in private credit, but starting to see it in public credit as well.
Well, let's get a view on that, because Goldman Sachs' CEO, David Solomon, also gave his take on the U.S. debt burden, to Kriti's point, in an interview with David Rubenstein.
If we continue on the current course and we don't take the growth level up, there will be a reckoning in this. And the bottom line is we have to find people, to buy and finance our debt. And, ultimately, it's not going to be other people around the world. If it keeps growing, it's going to turn to us.
Lots of things to worry about on the horizon, from private credit to public credit. But then again, there's plenty of positivity as well, especially when it comes to the boom in AI, technology, even the possible easing of trade tensions between the United States and China. Of course, it's been another lively week when it comes to these markets. Let's get a big picture takeaway. Bloomberg's Farah El-Bairawi is all over it. Farah, I don't even know where to start. I feel like we've been drinking out of a fire hose. What was the takeaway for you?
Well, Kriti, I'll start with the key theme of this week, which was earnings. Let's look at Europe quickly. You had a very strong season so far in Europe, about 60% into the season, and 5% of companies have beat, you actually see 5% growth in EPS versus analysts. They were expecting 0.4% drop at the start of the season. So a really big beat for Europe here. And over in the US, you have 13% growth. Analysts had expected something akin to 8% at the start of the season. So expectations were high, but companies are easily beating those expectations. Over in Europe, you have banks, energy, are among the sectors that are beating quite handsomely in the 70 to 80% range. But overall, Europe is seeing a pretty healthy beat rate compared to its own history. But in the US, it's actually one of the highest in 4 years, if not the highest at the moment in 4 years, both on the EPS and on the sales beat. So earnings continue to be quite healthy. And that's why even in the face of all of those risks, you're not seeing the market necessarily going off a cliff, even though there's a little bit of a wobble, especially in the US at the moment.
Yeah, but the earnings story showing that resilience. So that's at the corporate level then, Farah. What about at the macro level and how the central bank action kind of overlays the corporate story?
Exactly. So that's where you started to see the wobble in the U.S. You have the concerns on the AI capex that nearly doubled for some of those companies, but you also have the Fed coming in and saying December is not certain. That's not what the market is expecting. And you've seen that have more of an impact on the U.S. market than in the U.S., where the ECB did hold rates, but Deutsche Bank economists are calling this a resilient pause in face of a resilient economy.
Yeah.
In the U.S., the Fed is potentially not cutting rates with the S&P 500 trading at 23 times earnings, price to earnings ratio, when stock 600 is trading at about 15. Yeah, so really elevated levels compared to its history there for the S&P 500.
Really fascinating dynamics that we're seeing, of course, from the macro and the micro. Bloomberg's Farah El-Bairawi, we thank you so much. Tom, I think we made it. I think we made it to the end of the show. I think we're ready for the weekend. Are you dressing up for Halloween?
My kids will be. Okay. So we're going with a gothic queen for the eldest and possibly a pumpkin for the 2-year-olds. So we'll be doing trick-or-treating. I'm looking forward to as well USA versus Scotland at Murrayfield, 5:40 tomorrow. The USA will get trounced. They've had a good season, though. It's an important game because it leads up to the pick in December for the 2027 World Cup. So that could be a good one to watch. The first time they're playing in Murrayfield for a long time.
I guess the Gothic Queen and the pumpkin will be joining you at that game. That does it for the opening trade. The Pulse is up next. This is Bloomberg.